Good evening. My name is Jackie Knight. I'm the Corporate Training Director with STC, and I'm glad to have you join me this evening for tonight's webinar. We are going to talk about a couple of advanced kind of topics, insights into self-directed retirement accounts. So I hope you will find this very interesting. Before we get started, I do need to tell you just a bit about STC. We are a retirement plan administrator. A full-service retirement plan administrator. We do not, however, give legal, tax, or investment advice. We also don't represent or endorse, sell securities or investments of any kind. We are not a registered investment advisor, and we don't represent or endorse any particular investment. I may be talking about some during this webinar, and those are to help you think through how you might utilize that type of an investment in your retirement portfolio, but we don't represent or endorse any investment opportunities. We do recommend that you consult with your legal, tax, and investment advisors prior to making any investments. This evening's webinar is going to give some basic information about self-directed retirement accounts, as I always assume that I may have some folks that are unfamiliar with self-directing. We are going to talk about some account specifics and Roth conversions. I'm going to talk a bit about non-recourse loans. We're also going to delve into UBIT and UDFI, some tax items that could affect your retirement account. We're going to discuss the retirement account LLC structure that STC uses for each of our clients and why we use that. I will go into details of the services that we offer, and then I will open the floor for your questions. So first, to get started, let's talk about self-directed retirement plans. What do I mean, what do we mean when we use that term, self-directed? A self-directed retirement plan is not a type of plan, but it means that you are holding your retirement plan with an entity, a company, that permits you to choose any type of asset that is allowed by law. So that would include things like real estate, which some people consider a very non-traditional asset for a retirement account. Self-direction also means that you are going to manage the investments in your retirement plan. You're going to make the decisions that relate to those investments. So for example, if you did choose to own a piece of real estate in your retirement account, you would be the one that would determine how you're going to use that property. Would you rent it? What would be the rental rate? Would you do some repairs to this property and maybe hold it for a while and then sell it down the road? You would determine what repairs you want to make, what improvements, what that selling price would be. So by managing your investments in a self-directed account, you basically have more control over those investments. And because of that, you may be able to earn more, especially if you have a particular area of investing expertise that you can utilize in your retirement portfolio as well. So again, a self-directed plan is not a type of plan. It just means that you are working with a company that permits self-direction. Now, why would you want to self-direct? There are several important reasons, and one is that you can truly diversify into different types of assets. You're not restricted to just stocks, bonds, mutual funds, but you can include things like real estate, mortgages and notes, private business ownership. And again, you have that control function because you are actually in control of the decisions related to the investments that you are making. You do also have the ability to use leverage on a real estate purchase. We are going to talk some more about what kind of leverage you can use and how that might affect your account. But because you can actually, your retirement account can borrow money to invest in a property, that gives you the ability to use other people's money, and you don't have to fully fund the investment from funds in your retirement account. Now I am going to talk about some specific type of retirement plans on this slide, and I'm going to bring two out together because they have some similarities. A traditional IRA, individual retirement account or arrangement, and a Roth IRA. Now, the thing that is the same about these is that they have the same annual contribution limits. So every year you can make a contribution to a plan that you qualify for. In the case of a traditional and a Roth IRA for 2022, the amount that you can contribute from your earned income is $6,000. That's the maximum. If you are 50 years or older, you can add $1,000 to that as a catch-up, and you can contribute $7,000. Now, there are some differences between these accounts. Contributions to a traditional IRA are made pre-tax. In other words, you don't include, let's say you do put in a full $6,000. That $6,000 is not included in your taxable income for that year. So it's pre-tax. Retirement accounts are meant to benefit you when you retire, so you get some tax advantages with a traditional IRA and others. And you are not taxed on those monies until you begin taking qualified distributions or taking distributions from the plan. A Roth IRA is different. Roth IRA contributions are post-tax. You will pay taxes on those monies. They won't be considered as a deduction from your income for the taxable year. However, not only does a Roth account earn tax deferred, it really earns tax free on the earnings in that account. When you reach retirement age and begin taking qualified distributions from a Roth IRA, they are not included in your taxable income at this point in time. And so this is a way to really earn tax-free in a retirement account. So that's the difference between Roth money and other money. We will talk a little bit more about Roth accounts and some things relevant to them. A SEP is a simplified employee pension plan. I know that some small businesses or smaller businesses might have a SEP. If you're a sole proprietor, you could actually have a SEP on your business. It would permit you to make both an employer and an employee contribution. For 2022, the maximum annual contribution to a SEP plan is $61,000 from that business earning. So if you do have a business, you may want to look into setting up a SEP plan so you can make contributions from your business earnings into that account, because obviously you can contribute a lot more than you could to a traditional or a Roth account. A simple plan, a savings incentive match plan. I know a sole proprietor has used this. I know that sometimes partnerships might use this type of plan. Again, you can check with your accountant to see what type of plan might be best for you personally. The annual contribution limit for 2022 in a simple plan is $14,000. Both the SEP and the simple did increase for 2022. Now, I brought out on your slide 4 different plans that say former employer. A 401k is a for-profit corporate plan. A 403b, often used by charitable organizations or nonprofits. TSAs, tax-sheltered annuities, and TSP, thrift savings plans. Just some different types of plans that employers may offer. If you formerly worked for an employer and participated in one of these types of plans, then you can move the money out of that plan into a plan you qualify for now. And we're going to talk a little bit about portability, moving funds between different types of accounts. But if you're no longer employed, you don't need to leave those monies there. You can move them, and you move them into a plan that you can self-direct if you like. Now, if you are currently employed and participating in one of these plans, then you will need to go to your plan administrator and ask if you are eligible to move some of the money out. There are some times when you have brought money into a plan because you moved to this job from another job that had a plan. If you've reached a certain age, some plans do permit you to move monies out, even though you still might be employed. So that would be a question you would take to your plan administrator where you are working. But again, if you formerly worked and you no longer work, then you can move those monies out of that plan. Another type of plan that is newer, although it has been around now for quite some time, is called a solo 401k. That's kind of the vernacular that we use in the industry. And it means it's a 401k type of plan, but it is for a sole proprietor, really somebody who is in business for themselves, by themselves. You can have very, very limited employees. A spouse can sometimes work with you in this business, but it really is meant for a sole proprietor. It does have some very nice features for a sole proprietor. It does permit you to make both an employer and an employee contribution into the plan. It also has a Roth provision, so you could designate some of those funds as Roth funds. Again, they would be taxed in the year that they were contributed, but they would earn tax-free when you took a qualified distribution. The 401k also has a loan provision that can be very helpful to business owners. You set up the terms of the loan, interest, payback provisions, all of those things in the solo 401k documents. And then that loan, those monies can be used really for any purpose. They don't have to be used for the business's purposes, as long as it's paid back, according to the terms and with interest. You have that loan provision to borrow money from basically your retirement account. So that's another nice provision. For 2022, the contribution maximum for a solo 401k is $61,000. You see, that's very high, like the SEP. Plus, you have a catch-up provision if you're 50 years or older of an additional $6,500. So a total you could contribute from the business's earnings of $67,500. Now, if you don't currently have a plan and you want to get a plan set up, I always encourage people to do it sooner rather than later. You do have to have a plan set up by December 31st of the calendar year in order to make a contribution from your earnings for that calendar year. So just keep in mind that if you don't have a current plan, you want to get it set up. Like, for instance, if you have a traditional IRA, but you might like to set up a SEP or a solo 401k, you would need to get those set up so you could make contributions to them for this year. Okay, so we've talked about different kinds of accounts. I do want to talk a little bit about rollover, portability, and consolidation. Because we could potentially have two different types of money. We can have regular retirement contribution money or Roth retirement contribution money. There are some nuances that need to be considered if you're moving money between types of accounts. So if you wanted to move money from an IRA to a SEP, you can do that, or from a SEP to an IRA. They are like kinds of money, and you can move money between those accounts. Now, if you have money in an IRA, a SEP, or a simple, you can move it to a Roth account. However, there is a little distinction here, because you remember I said that an IRA's contributions were pre-tax, as are SEP and simple contributions, but Roth are not. So if you are going to move untaxed money to a Roth account, there will be a tax consequence. So that is one thing to consider. We'll talk a little bit more about that. If they're like accounts, like that top bullet point, then there's no tax consequence, not subject to tax. Rollovers to a Roth are going to be included in your income for the year when you do that. It's called a conversion. You're converting to a Roth, and it will be taxed. In addition, simple IRA plan distributions before the second year period after beginning participation may incur an additional tax as well. So there are some time constraints when you put money into a type of plan that you have to adhere to. You have to have the plan open for so long before you can begin taking distributions that aren't penalized. Now, contribution limits and RMD, that's required minimum distribution. I already mentioned traditional and Roth. You can contribute $6,000 from your income, $7,000 if you're 50 years or older. Now, with a SEP plan, I mentioned the $61,000. Your business for a SEP can be either incorporated, where you're getting a W-2 from your business, or it can be a sole proprietorship, where you are completing the Schedule C on your tax return as self-employed income. So with either one of those two, there's a little difference in how much you can contribute. So with W-2 income, you can contribute 25% of your income up to a maximum of $61,000. With sole proprietor, self-employed income, 20% up to a maximum of $61,000. So again, this is something you would discuss with your tax accountant, depending on how you are operating that business, how you're taking earnings from it, would be determine how you would calculate the dollar amount that you could contribute. I had already mentioned that the simple contribution for this year is $14,000. I do want to mention required minimum distribution. Once you reach a certain age, and now it's 72, that increased from 70 and a half in recent years, you are required to take minimum distributions from most retirement accounts, like a traditional account, like a SEP account. However, a Roth account does not have an RMD. You are not required to take minimum distributions from a Roth account. Let's talk just a little bit about taking distributions. If you take early distributions, there may be penalties. Payments that you receive before age 59 and a half, that's kind of when the IRS considers you have reached full retirement age, 59 and a half. If you take payments before that, they are usually subject to an additional 10% penalty tax. Now, the recent Secure Act did make some exceptions, so you would want to talk with your tax advisor prior to taking any early distribution to determine if and what kind of consequences there might be for doing that. But usually, an early distribution is subject to an additional 10% tax. These early distributions must be reported to the IRS, and the amount of early Roth distributions that's attributable to your contribution is not taxed. So let me just say that again, maybe a little more clearly. You remember that I said your contributions into a Roth were taxed in the year that you made that money, in the year that you made that contribution. So here, looking at this taking money out, any amount that can be attributed to your actual contribution is not going to be taxed. So that is a calculation that needs to be maintained. You need to be able to calculate that, but that is one thing that you can consider when you're taking an early distribution. If it's attributable to a contribution, you were already taxed on that. Again, always best to talk with your tax advisor to make sure you understand the specifics of your personal situation. Now, Roth accounts. Again, I mentioned the advantage that the earnings on Roth won't be taxed if you're taking a qualified distribution. So when there's a qualified distribution, it is not included in your taxable income that year you take the distribution. No required minimum distribution from a Roth account. Now, there is a 5-year holding requirement for tax-free distributions. So from the date you open a retirement account, a clock starts ticking, a 60-month clock. So it's not calendar year. And you need to complete that 60 years before you can begin taking qualified distributions from the account. If you are converting money to a Roth account, then that clock starts ticking each time you make a conversion with that converted amount. So let me just give you an example. Let's say you have a traditional IRA. You want to convert some of those monies to a Roth IRA. let's say you have $100,000 in your traditional IRA. You set up a Roth IRA. You don't want to move all of that money into the Roth account at once because it will all be taxable in that year. So maybe you've decided you're going to convert $20,000 of your traditional IRA, put that into the Roth. Then the next year you're going to convert another $20,000. So that way you spread out the taxes that you need to pay on these conversions. Well, each one of those conversions has its own 5-year holding time period. So again, you want to discuss that with your tax accountant to make sure you understand when would I be able to take tax-free qualified distributions from my converted amounts. So just some things to have in mind, but you certainly can do it, and many people do that. I understand that there is some legislation pending that may make it difficult or impossible for wealthy individuals to do conversions to Roth down the road. I don't believe that has been enacted yet, but that's something that you would want to consider depending on your income, how much you're earning each year. Income limitations. You do have income limitations to contribute directly to a Roth account if you earn, and it's depending on if you're single, married, filing separately, jointly, your adjusted gross income. There are some income limitations, but in the past, you could make a contribution to a traditional and convert to a Roth and kind of get around that income limitation. That's what this legislature is addressing. So we'll have to see how that works out in the next couple of years. Now, when you make a conversion, then you will have taxes due and payable on those amounts that are converted. And if they are paid from the converted account, then that may be considered an early distribution and have a penalty. So you do want to consider, if I am going to convert and I am going to have taxes, how much are those taxes going to be? Because more than likely you are not going to want to take them from the account and incur this penalty. You may want to pay them from outside of the account. You certainly can convert multiple accounts. I've talked with people who, have accounts set up all over the place. So they might want to convert several of the accounts into a single Roth account. You can convert partial accounts. So again, back to that example, if you have a traditional, you don't have to move all of the money from one account to the other. You can do it in increments. And we always recommend that you check with your tax advisor who will understand your personal situation in detail and be able to advise you well. All right, let's talk a little bit now about non-recourse loans that I alluded to earlier as actually one of the benefits, advantages of having a self-directed account if you're interested in real estate purchasing. So first off, if your retirement account is going to get a loan to purchase a property, it must be a non-recourse loan. So what is a non-recourse loan? It means that the security instruments, the notes, the mortgages, they allow the lender no recourse against the individual account holder, you personally, or the balance of monies in your retirement account. The lender, if there's a default on this loan, cannot go to those sources of income. Their only recourse is the property that the loan is on. So that's why it's called non-recourse. It's much more like a commercial loan, and it's understandable because it's your retirement account that's getting this loan, not you personally, and your retirement account doesn't have any income, so there's no income or employment verification. So it's just a different type of loan than a personally guaranteed loan. So I'm going to run through just some general industry standards If you would like more detailed information, we do have a previously recorded webinar on our website that you could listen to get some more guidance and perhaps to determine how you might go about finding a non-recourse loan. So generally, the required documentation for a non-recourse loan is going to be, of course, a loan application, a purchase and sale contract. They're going to want to see a copy of your IRA statement or whatever kind of retirement account you have. They will likely want an appraisal of the property. And if it's rental, they're going to want a rent roll, want to see what it's been renting for. Regarding loan guidelines, the maximum loan to value is probably going to be 70%. So you are going to need to put down a larger amount from your retirement account than you would on a personally guaranteed loan. Maximum term, we've seen could be 20 to 30 years. We have seen adjustable rate mortgages for non-recourse loans, 3-1, 5-1, 7-1. The lender will be looking at an income expense ratio in evaluating the loan, and they're usually going to want to see something like 1.25 income to expense ratio. And they very likely will require you to hold monies in reserve in your retirement account relative to expenses on this property, anywhere from 3 to 6 months of property expenses. Now, let me explain why they do that. Because your retirement account owns this property, any expenses related to this property must be paid by your retirement account. So if there are property taxes, those taxes need to be paid from your retirement account. So there needs to be money remaining in your retirement account or investments that you can liquidate quickly to get money to pay these expenses. So that's why the lender is going to look at those kinds of things. You know, property taxes, is it an older property and it's likely you might need to have a new hot water heater put in? You know, they might look at just maintenance and repairs, some amount that they want you to hold in that account so that you can accommodate those if they should arise. So you may need to have anywhere from 3 to 6 months of reserves to cover any of those expenses. Eligible and ineligible properties. Eligible, certainly single-family residences. Some condos you would need to check with the condo association, etc., if they permit retirement account owners. 2 to 4 plexes. Multifamily units like small apartment buildings, retail, office, warehouse, all of those are eligible properties for non-recourse loans. Ineligible properties generally are mobile homes, timeshares, and condo hotels, certain restaurants, any residences that have 5 or more acres, and farms. Those are usually ineligible. So when you are thinking about this loan, you will want to consider, okay, what type of property am I looking at? Now, you might also be thinking, how, I may not be able to fully fund this investment from my retirement account. You could partner with other investors. So we'll talk a little bit more about that and still get a loan on the property. So that is a possibility. And we're actually very good at working out those kinds of complex transactions, so we can assist you in making sure that all the documents are proper and allow you to do that. Now, when you use leverage or when you invest in certain types of businesses, taxes could come into play in your retirement account. Now, the taxes that could come into play are unrelated business taxable income. Your investment is generating income that the IRS considers unrelated to the operation of your retirement account, its purposes, or UBIT, unrelated business income tax, of which a subset is UDFI. And let me just see if yes, I'm going to explain that in detail on the next slide. So most IRA investments generate passive income, so taxes don't come into play. But UBIT was designed by the IRS so that charitable organizations, nonprofit organizations, wouldn't have a benefit over for-profit organizations if they had some kind of income-producing part of their business that wasn't tied to their tax-exempt status. So, nonprofits, charitable organizations, they are functioning for an exempt tax purpose. They're doing some charitable work. But if they're generating income from selling something that doesn't relate to their mission, then that becomes taxable income. And the IRS has now ruled that this may also apply to certain types of income that are generated within your IRA. Again, most of your IRA's investments are passive, and they would generate income that would be exempt from UBIT. Things like interest income, rental income, dividends, distributions. Now, real estate investments generally are also passive investments. If you don't take out a loan to own it, if you fully fund the investment, it's probably generating rental income, so that wouldn't generate any particular taxable consequence. It's when you use leverage that might come into play. The other type of thing, I talk to a lot of real estate investors, and they may be purchasing, fixing up, and then reselling real estate properties. They could be operating that as a business. Now, if they are doing that in their retirement account and they do it over and over and over and over again each year, then the IRS might look at that as they are running a business inside their retirement account, and then UBITs might come into play. Now, if they're doing 1 or 2 transactions a year, then that doesn't look like a business. That looks like an investment that you are working on. So if you are a real estate investor and that is a type of investing you would like to do in your retirement account, we would encourage you to talk to our client services department about what they recommend, and then you can use that guidance to determine how you would like to proceed with your real estate investments in your retirement account. Generally, the sale of real estate is considered passive, as long as its intention was to hold it, fix it up, hold it for a gain, and then sell it down the road. So just some things to think about if you happen to be a real estate investor and planning on doing a number of real estate transactions in a single year. Let's talk in a little bit more detail about unrelated debt financed income. So now we're back to the situation where your retirement account is going to go to a non-recourse lender to get a loan to enable purchasing of a piece of real estate in your retirement account. So this is UDFI, unrelated debt financed income. So debt financed income, you are making income on a property that is debt financed. Now UDFI applies to the income that's generated from an asset that was purchased using financing, and it's based on the net income of the property. So let's just think about this a little bit. Let's say you own a rental property in your retirement account that you debt financed. You got a loan. Well, you have expenses for that property. Maybe you pay your retirement account pays the utilities for the renter. You have to pay for lawn maintenance. You maybe have to pay for a new roof or a new water heater. All of those expenses would be deducted from your rental income, and then you would come down to the net income that the income tax is payable on. So it's always net income. The first $1,000 of that net income is exempt from taxes, so you get $1,000 tax exempt. Then the taxable portion of that remainder is based on the ratio of debt on the property. So, if you finance 70% of the property's cost, then 70% of that net income minus $1,000 would be subject to the tax. And I'm going to show you an example to help you calculate that in your head. Now, when the asset is sold, if there is still a loan on it, or if there was a loan in the previous 12 months, then a portion of that gain will also be subject to UDFI. So if you pay off the loan and then it's 12 months or longer later, then that any proceeds appreciation would not be subject to UDFI. Now, one thing I do want to let you know is if we are talking about a solo 401k plan that owns a piece of property, UDFI does not apply to a solo 401k plan. So that's another little advantage. If you happen to be running a real estate investing business and you have a solo 401k plan on it, you can use that real estate investing expertise in your retirement plan and use leverage and not have these tax consequences. So that's a nice benefit. Let me walk you through an example investment. I have talked to some people who have said, no, I don't want to do this because I don't want to have to pay any taxes from my retirement account. But honestly, you might want to evaluate the investment to see, even if you have to pay some taxes, it might be worth your while if that property is going to generate sufficient income. So here, let's look at a little example. This is a rental property that you purchased 50% debt financed. So that means, let's say the purchase price was $400,000. You got a loan for $200,000 and you used $200,000 from your retirement account to buy that property. Okay, so it's 50% debt financed. The annual net rental income on this property for last year was $12,000. So notice I say net rental income. So that means all the expenses were deducted and what you were left over with was $12,000, $1,000 a month. The amount of that $12,000 income that's going to be subject to the UDFI is $5,000. And we got that by taking $12,000. Remember I said only the portion that's debt financed is subject to the tax. So $12,000 times 50% is $6,000. And then I also told you that $1,000, the first $1,000 was tax exempt. So I take my $6,000, I take $1,000 off of it, that's tax free. So I have $5,000 that's subject to UDFI. So $5,000 out of my $12,000. Now, the IRS has said that it's the trust tax rate that is charged, and the trust tax rate is a graduated tax. It ranges from 10% to 37% as you move up the dollar amount of the income. So for 2022, the trust tax rate is 10% up to 37%. The tax rate didn't change, but the cutoff between the levels did change. So in 2022, it actually went down a little bit. This example went down a little bit. The UDFI taxes on this $12,000, the amount that you earned, is $815. So your net income after UDFI is $11,185. So looking at that example, you may think, oh, okay, well, I'm still making $11,185. Is that percentage, is that rate of return good for me, even though I do have to pay some taxes? So just an analysis that you want to go through, you and that tax advisor you have. So back to UBIT, UBTI, or UDFI. If these do happen in your retirement account, they are reported to the IRS on Form 990T. The taxes do have to be paid from the retirement account, but of course you had that $12,000 income into the account, so you have the $800 and some to pay out of the account. Again, it's payable at the taxable trust rate, and check with your tax advisor. Again, this really doesn't happen that often, but because I have so many real estate investing folks interested, I do want to be sure that we discuss it. I want to mention the structure that STC uses for each of our clients' accounts. We do use an LLC structure. our operations department, when you open an account with us, they set up an LLC that is designed specifically to be owned by a retirement account. So it is a specialized type of LLC. And that LLC becomes the investing entity for your retirement account. And we use this structure because it gives you a number of benefits that can be very helpful in your investing. It does give you maximum flexibility in structuring complex transactions. So if you have multiple parties to a transaction, because you can you can cooperate with someone else, you can have funds, you can co-own something in your retirement account. If you have multiple parties to an investment, if you are going to debt finance a piece of real estate, if you are going to have one of these parties do some work on a property, there are all different kinds of configurations that you can do within the rules of the IRS and the regulations, but the LLC structure makes that more easier, much easier to accomplish. It is a limited liability company, so it does provide an additional layer of asset protection. It also gives you checkbook control over your retirement funds. We know that sometimes investments can come and go pretty quickly, so you need to be able to move on them. With this structure set up, you have immediate response to investment opportunities, same day or next business day. Now, I do have checkbook control in quotes because we don't give our clients the checkbook for their account. And we really do that as a protection for you, unless you are an expert in all of the rules that relate to retirement account investing. You could unknowingly engage in a prohibited transaction, and the penalties for doing that can be very severe, up to forfeiture of your retirement account, and actually it all becoming taxable income to you. So what we do is we look over your transaction, and if everything is in order, then we can same day or next business day fund your transaction. So it's really a kind of protected checkbook control. That's what I call it. Using this structure does simplify asset titling. For example, if you are going to do real estate, you can actually go to closing on behalf of your retirement account, and you can sign the closing documents. You don't have to send them to our office where they wait for someone's signature there, which is a little different than some companies. So it does simplify asset titling, and it does ease pooling or partnering with other funding sources. Straightforward. So let's just actually talk a little bit about that, partnering with others to co-own or co-fund an investment. You can actually partner with yourself, your spouse, and family members, as long as this partnership, this full purchasing happens at the inception of the purchase transaction. So it is possible to do that, even though normally you can't do a direct transaction between your retirement account and yourself, or your retirement account and your spouse, or your retirement account and your father or your daughter. But if you partner with them at the inception of the purchase transaction, it is a viable transaction, and we can help you work out those details so that it is within the rules. You may have investing colleagues that you would like to partner with. You can partner with an LLC. You can partner with an investment syndication. So you can partner with other entities to co-own an asset. And here's a little schematic of our retirement plan structure. So you'll see on the upper left, this would be your current custodian. Say you decide you want to work with us. You would fill out some documents that would direct your custodian to transfer or roll over to our self-directed custodian. And then our operations department would be working to set up the LLC in the state of your choice that you wanted to, whatever state you would like to use, and they can discuss that with you to help you determine where you might want that. Once your LLC setup is complete and the money has moved to our custodian, then the ownership interest of that LLC goes to the custodian. That's what they hold in your account. And the funds move to a bank account that your LLC has access to. So now you're ready to invest. And in this example, you have 3 different types of investments. Investment number 1 is a tax lien. Investment number 2, you own some precious metal, gold bullion. Investment number 3, you own a foreclosed piece of real estate, but you don't own it in its entirety. You have 3 other co-owners, and your co-owners are your father, your daughter, and some of your personal money that's outside of your retirement account. Normally, those would be disqualified persons, but again, if you co-invest at the inception of the purchase transaction, this is a viable option. So we have many folks who come to us who want to do this exact thing. Maybe they want their spouse's retirement account and their retirement account to partner, or they have some personal investing money they want to go in with their retirement account to own something. So that is certainly an option. Let me review our full service approach and what we offer our clients. We offer that retirement account LLC structure setup I just discussed, that protected checkbook control. We have CPAs and attorneys to answer your technical questions. Unlimited guidance on transaction compliance. We have a wonderful client service department that you can call and talk over your anticipated transactions, who the parties are, the timing of it, and they can give you guidance on how to best accomplish that for you. We handle all of the back office support. There are records that need to be maintained. We actually maintain financial statements for this LLC. So you can see a balance sheet and an income statement and a statement of cash flow. You have online client access to that information. We supervise the regulatory reporting that is required, and we oversee that annual valuation that must be done. So really, our goal is to give you all of the back office support and the transaction review expertise that you need so that you can spend your time finding the best investments for your retirement account. That's really where you will decide what those investments are. So how can we serve you? You may know that you'd like to open a self-directed account now. We can help you with that. You may have clients or colleagues who might be interested in self-direction, and we would be happy to get them more information either through you or directly if you'd like to get them in touch with us, or you may simply need more information. So we do have a website that has a lot of details on it and also has client testimonials. So you may hear what some other people have done in their retirement accounts. You can go check that out at stcira.com. Our corporate number is on the screen for you, and you can get in touch with me after the fact if you would like to discuss any questions or you would like to get some paperwork to get started. Now, I am going to open up my question box, and I did have some questions come in prior to the webinar, so let me pull those out. And please, if you haven't typed in a question and you have one, please do that now. I will look at those. Okay, so first off, what is the time frame to get my account up and running? Typically, from the time we receive your paperwork, it can take 4 to 6 weeks from the time we get that original paperwork. And that has to do with getting your current custodian to move the money to our custodian. That can be a process in itself, and also then the time frame to set up that LLC. So we will work diligently to keep that process moving, but some of that is outside of our control. But we will do that. During that setup time frame, we will coordinate the transfer of the assets and that setup, and we keep you updated. We have some emails that you will get during your setup process so that you know the progress. And once the funding of your new account is complete, then we send you a confirmation email and you'll receive a binder with copies of all of your signed documents, all of the legal documents, and also instructions for future funding contributions and funding transactions. So We do ask that you give us that time period. It may be set up more quickly than that, but there are sometimes things we can't control. So if you know that you already want to do this and you already have investments that you're going to go out and look for, please do get the paperwork started right away. We don't want to disappoint you when you're ready to invest. Okay. Can I use my IRA funds to make an investment with my spouse? This was a preliminary question. Generally, I kind of answered it, but typically the answer is no. Your IRA is prohibited from engaging in a transaction directly with your spouse or your spouse's IRA. However, again, if you are investing at the inception of the transaction, if the investment is structured properly, yes, you can. So we really encourage you to call us and discuss any kind of complex transactions in advance in the early stages so that we can provide you with the information that you need. Make sure you're not heading down the road of a prohibited transaction. If I have a rental property in my account, who does the renter send their rent check to? That really depends on whether or not you're using a property manager. We do highly recommend using a property manager because, again, you are a disqualified person to your retirement account. So you have to be very careful in what you do with a property that your retirement account owns. You can really only do ministerial kinds of duties. That's how it's kind of defined. So we do highly recommend a property manager. And when you use a property manager, they will collect the rent. The checks are made payable to them. They take out their fee, any expenses, and then they will forward the excess funds to your IRA LLC. So they will come to us and we will deposit them into your account. If you're not using a property manager, then the checks, they must be made payable to your IRA LLC because that's who the owner is, not you personally, and mailed to our office. And they can mail them to you, but then you're going to have to turn around and mail them to us. We will, as soon as they're received and deposited, then we will send you an email so you know those funds have been received and posted to your account. Okay, a couple more questions. If I want to put IRA money into a self-managed stock brokerage account, can I actively trade in that account with IRA funds? Yes, actually you can do that. We have clients who, like between transactions, let's say they hold a property, then they sell it, and they're looking for their next investment. They might have a large chunk of money in their account. They don't want it just to sit idle earning like escrow interest percentage. So they may put it into something, into a stock brokerage account. You can do that. The brokerage account does have to be in the name, it needs to be set up as a business account with whatever firm you choose, and it does need to be in the name of your IRA LLC. We also do ask that you send us copies of your monthly statements to ensure, we need to just ensure that you haven't made any deposits or withdrawals from that account personally, because remember, it is owned by your retirement account. And if you did that, those would be contributions and distributions. So we want to make sure that you're not doing that outside of it flowing through your retirement account. Okay, and this will be my last question. It's a little complex, so it actually looks like it's two parts. A traditional IRA requires the owner to begin taking withdrawals at age 72. That's that required minimum distribution. If I own real estate in my account, am I required to sell it at some point so that I can take that RMD as cash? And then it says, if income from the property exceeds the allowable contribution, how is that handled? Okay, so I'm going to answer the second question first. Okay, so this is an IRA owner has a real estate in their account, and the income from that property is exceeding the allowable contribution. Okay, I need to make a distinction here for you. income that's earned on the investments in the retirement account has nothing to do with your annual contribution. That's entirely separate. Your annual contribution can be made from your earned income. Each year that you have earned income, and you can make a contribution from your earned income up to that maximum amount that I told you was allowed for the different types of accounts. So your contributions are a completely different thing from income that's earned within your account. So you don't have to even consider that question. Now back to this person has reached age 72 and they need to take a required minimum distribution, and it sounds like they don't want to sell that property. What you can do is as of the end of the year, you can have that property appraised, and then you can take a property distribution equal to your RMD if you like. And then that property would be retitled in your name personally and your retirement accounts based on now the property ownership, because now you own a percentage and your retirement account owns a percentage. This can be done. I've seen people do it when they want to distribute a property to themselves and then live in it. They actually fully retire and now they want to live in it. But you can do that, and you don't have to sell the property. So you would want to talk to us about how you go about doing that so we can make sure that all works well for you. All right, well, those are all the questions I can take for tonight. If you do have more questions, please do call our office or send me an email. I would be happy to talk with you personally. And thank you so much for joining me this evening. I hope you will join us on our next webinar. Good night.